Bollinger Bands are not a buy or sell button. They are a dynamic map of volatility wrapped around a moving average. When you read them properly, they tell you when price is statistically stretched, when the market is coiled and about to expand, and when a trend is so strong that mean reversion will hurt you. Today we unpack the math, the two regimes most traders confuse, and how to combine bands with momentum so you stop fading real trends. The middle band is typically a 20-period simple moving average. The upper and lower bands sit two standard deviations of the same 20 closes above and below it. Because standard deviation is recomputed every bar, the bands breathe with realized volatility. If returns were normally distributed, roughly 95% of closes would fall inside. Markets are not normal, they have fat tails, so closes outside the bands are common and meaningful, but never rare enough to trade blindly. The distance between the upper and lower band is bandwidth, and bandwidth is your volatility regime gauge. Narrow bands mean realized volatility has compressed, and a directional move is statistically more likely to follow. Wide bands mean volatility has already expanded, which often coincides with trend exhaustion or capitulation. Track bandwidth as a separate series, not as eyeballed width. Compare current bandwidth to its own 6-month percentile, so you know whether you are in a sleepy market or a violent one. In a sideways market, the bands behave like rubber walls. Price tags the upper band, momentum stalls, and it drifts back toward the middle band. Tag the lower band, same thing in reverse. The cleanest setup is a close back inside the band after poking outside, with a stop just beyond the recent extreme and a target at the 20-period mean. This only works when the market is actually ranging, which you confirm with a flat middle band and an ADX reading under 20. Here is where most traders get destroyed. In a strong trend, price does not revert from the upper band, it rides it. This is called walking the band, and every short you take into it is fighting the dominant flow. The tell is a sloped middle band and consecutive closes in the upper quintile of the channel. In that regime, flip your bias. Pullbacks to the middle band become trend continuation entries, not fades. The same band that was a ceiling in a range becomes a magnet in a trend. Volatility is mean reverting even when price is not. A Bollinger squeeze is when bandwidth drops to a 6-month low, often coinciding with the bands moving inside the Keltner channels. That coiled spring resolves with an expansion bar, and the direction of that first decisive close usually defines the next leg. Trade the breakout in the direction of the expansion, place your stop on the opposite side of the middle band, and trail along the band as price walks. %B normalizes price location. 0 is the lower band, 1 is the upper, half is the mean. It lets you spot divergence cleanly. If price prints a higher high but %B prints a lower high, the second push did not stretch as far statistically, even though it went further in price. That is a momentum failure inside the volatility envelope, and it often precedes a reversal back to the middle band. Combine with an RSI divergence for stronger confluence. Look at Apple on the daily. Notice the stretches where price walks the upper band for weeks during an uptrend, then how a bandwidth contraction sets up the next directional move. The fades that worked in the chop in the middle of the chart would have been disasters in the trending segments. Same indicator, two completely different playbooks. Your job is to identify the regime first, then pick the trade. Bollinger Bands lag because they are built on a moving average, and the standard deviation calculation assumes a stable mean, which trends violate. So never trade bands alone. Pair them with ADX or slope of the middle band to classify regime. Use RSI or MACD to confirm momentum at the tags. Avoid optimizing the period and sigma until the math fits one chart, that is curve fitting. 20 and 2 are the defaults for a reason. They describe the dominant monthly cycle on most timeframes. Tomorrow, before any trade, do 3 things. Check the slope of the middle band, rank current bandwidth against its 6-month range, and decide whether you are fading or following. Mean revert in ranges, trend follow when price walks the band, and respect the squeeze as a setup for expansion. This is education, not financial advice. Manage your own risk and trade the regime in front of you, not the one you wish was there. If this helped, do me a favor, hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.